And it will not be a very detailed recap. It will be a very quick recap. So please bear with me. Can you see my screen, Junaid?
Yes, sir, I'm seeing it.
Okay. So we started chapter number 15, which was long-term liabilities. And in my first lecture, we covered actually major characteristics of a bond. Okay. So bonds, they are long-term liabilities. Okay. And there are zero coupon bonds, and there are some bonds which are non-zero. So they pay you a coupon, a certain coupon. Zero coupon bonds are actually selling at a heavy discount. Okay, and the way it works, let me actually show you through. So there are two types of bonds. Let me share my whiteboard with you. Okay, so one is called zero coupon, and the other one is non-zero coupon. Okay, in US actually, normally the face value of the bond is $1,000. Okay, so the way zero coupon works is, as I said, zero coupon. So zero coupon bonds are sold at heavy discount. Okay, and why are they sold at heavy discount? The reason is they do not pay you any coupons. So the way it works, suppose it's a 5 years bond. Okay, so at the end of 5 years, you get as an investor $1,000. Okay, and how much do you need to pay, let's say at time zero? Of course, not 1,000, because there is a time value of money attached to this bond. Okay, suppose you pay $850 for this bond. Okay, so zero coupon bonds do not pay you anything at the end of each year. Okay, at the end of 5th year, which is maturity of the bond, you get the face value of the bond. So as an investor, let's say if you are interested to invest in a certain company's bond, and it's a zero coupon bond, after 5 years, you will be paid $1,000. Of course, if you would like to buy it today, you're hoping for some return. Okay, so you buy that bond at a heavy discount. The discount, of course, depends on how the company runs its business. If it's a very, very risky business, okay, the discount will be even more. But let's say if it's a safe business, for example, let's say Microsoft, Google, or any other company, large companies, right? The discount will be a little bit less. So this is a typical zero coupon bond. The way non-zero coupon bonds, so non-zero coupon bonds, okay, what they do, they pay you face value at the end of maturity. Okay, so you get the face value just like this one. Okay, but at the same time, they pay you what they call coupons periodically. And this periodicity can be, let's say, quarterly, it can be half yearly, it can be even yearly. It really depends. Okay, so let's say if you're buying a coupon, a non-zero coupon bond, and it has, let's say, 5 years maturity. So 1, 2, 3, 4, and 5. And let's say the coupon rate is, let's say 9%. Okay. So of course, at the end of each year, you get 9% of the face value. So 9% of the face value is how much? So 9% of 1,000 is, Junaid, how much? $90. Okay.
Yes. Yes, sir.
So at the end of each year, you get $90. Okay.
Yes, sir.
But at the time of maturity, let's say 5 years, you also get your $1,000 back. Okay. So this is in a way, it's your return.
Yeah, okay. Each
Okay.
year 90.
How much will you pay today for this bond? It really depends on what they call required rate of return.
Return.
Okay.
Okay.
And I'll explain it to you in today's lecture that what do I really mean by required rate of return. Okay.
So is it different from internal rate of return, IRR?
Yes, it is.
Okay, sir.
And I'll show you the difference.
Okay, sir.
Okay.
Okay.
All right. So the bonds that we covered last time, there are mainly two types of bonds.
Yeah,
one is called
secured
secured bond and the other one is unsecured bond. Okay.
Yes.
So those companies who are very, very established companies, they do not need to provide any kind of security to its investors. Okay. So the company has a long history, they have a credit worthiness. For example, yourself and myself will be very comfortable investing in, let's say, Google. And let's say if we are talking about Pakistan, we'll be very, very comfortable investing, let's say, in a company like Angro Fertilizer. Solid company, right? So these companies, they do not need to provide any security to the investors. So those bonds are unsecured. And unsecured bonds are called debenture. Okay? And there are some secured bonds. So those companies who are new in the business, or let's say whose credit worthiness is a little bit shaky. From shaky, I mean that they do not have good credit history. Okay. Sometimes what they do, they provide some sort of security to the bondholders, to their investors. Okay. It adds to the confidence of the investor. So the investors feel confident investing in those securities. Okay. And there are, for example, there are some features. One is convertible and the other one is callable feature. Convertible bond is actually those bonds which can be converted into common stock. But it is actually at the discretion of the bondholder. So the bondholders decide whether he or she wants to convert those bonds into common stock.
or not. Yeah.
Okay. Callability. So if the bond has a callability feature, then actually the issuer, the company, has the right, has the option. Okay. So it's not an obligation, it's a right. So they have the right to actually call those bonds. Or another way you can call it option. So they have the option to call those bonds back. Okay. So let's say even if they issue a 10 years bond, they can call it after 5 years. They can call it after 3 years. Okay.
Okay.
And we also covered the procedure, how those bonds are issued. The legal document that is that contains all the terms and condition, it's called debenture. Oh, sorry, indenture. It's called indenture. Okay, so we covered about different features of the bond. Today, what we will do, we will cover actually its accounting.
Yeah.
So let's say if a company sells its bond, how do they account for it? Okay, so accounting, if you know the basics, it's extremely simple. It's not that difficult. So a corporation records bond transactions with they issue bonds. If they redeem it, what do we mean by redemption, Junaid? Do you have any idea?
Sir, in simple words, redeem means that in accounting, sir, it's buyback, but simply it means that if you have done something wrong and you need to do something in order to make the damage done,
To
repair
reverse
something.
it.
Yeah.
To reverse
So
it, right? It's like buyback. Can you
Yes.
see it here? Buyback.
Yes, sir. Yes. Sir.
Okay. So redemption is buyback. So at the time of maturity, whenever, or let's say if it has, let's say, callability feature, if the bonds are callable and let's say the corporation decides all of a sudden that they would like to call those bonds back, okay? So the corporation actually make an accounting transaction whenever they issue a bond, or if they redeem it, or if the bondholders actually convert those bonds into common stock. Okay, so whenever these three things happen, you have to make an accounting entry. Okay, so let's take an example. Bonds may be issued actually at face value, below face value, or above face value. Okay, so as I said, the face value normally of the bond in US is $1,000. Okay, so let's say if they are issued at $1,000, okay, this one is issued at par, or they call it face value.
Face value.
Okay, but let's say if the bonds are issued at, let's say, 990. Okay, so this one is discount.
Yeah, discount.
Okay, so let's say if a book costs, let's say, 1,500 rupees, but you got that book, let's say, for 1,100 rupees. Of course, you got a discount, right? You pay less money compared to the stated value. Okay, but let's say if the bond is issued for 1,050 rupees or dollars, okay, this one is called premium. And in the next slides, I will explain why some bonds are issued at premium and why some bonds are issued at discount, and some of the bonds are issued at face value. There is absolutely no rocket science into it. It's very, very simple. So no rocket science to it. Okay, so whenever a company issues a bond, okay, what they do, they get cash for it. Yes or no, Humayun?
Yes, sir.
Perfect. So whenever
Sir,
they
as in yes, they do get cash credit.
Yes. So whenever a company issues a bond, a corporation issues a bond, they get cash. So whenever you get cash, of course, you have to debit cash. Okay. But at the same time, it creates a liability for you. Okay. So bonds payable. And if you see here, okay, I copied it from the book. Okay. The way it works, assets is equal to liabilities plus shareholders' equity. Okay, so every transaction has to be balanced. So let's say if your asset is increased by $100,000, okay, your liability is also increased by $100,000. Junaid, do you have a question?
Yes, sir. I'm not getting the credit part. Bonds payable. How is it a liability? I mean, if we are issuing bonds, I'm not getting the sense. Kindly repeat it for me.
So whenever you issue a bond, okay,
yes,
so let's say if you are buying a bond of Engro fertilizer.
Yes, sir.
So what do? You pay 100,000 rupees to Engro Chemicals or Engro Fertilizer, okay?
Yes.
And you get a bond. So bond is actually a claim. Of course, you do not give that money for free to Engro Fertilizer, right?
Yes, sir.
So Engro Fertilizer got cash, so that's why cash is debited. But at the same time, in future, they have to pay you. Yes or no?
Yeah, okay. They'll have to pay me.
So for Engro Fertilizer, this is actually for Engro Fertilizer. So this entry for Engro Fertilizer.
Okay, sir.
Okay, so they get cash, so $100,000, 100,000 debit, and then of course it's a liability. This is not a free money for them. They have to pay it back to you. Okay, so bonds payable is 100,000.
Okay, sir.
Is it clear now?
Yes, sir. Clear.
Okay, whenever a bond is issued, okay, whenever a bond is issued, as I said, in case of non-zero coupon bonds, you have to pay your investors, or in this situation, bondholders, periodic coupons, interest payments. At the beginning of this lecture, as I told you, Non-zero coupon bond has, let's say 9%. If it says 9% coupon, it means that the bondholder, or you can also call it investor, they will get 9% of the face value periodically. And this periodicity can be, as I said, quarterly, half yearly, or it can be yearly. Okay, so suppose this is yearly coupon. Okay, so the bondholder will get, and let's say the face value is $1,000. Okay, so the bondholder will get 1,000 multiplied by 9%, which is $90. So he or she will get $90 at the end of each year. Okay, so whenever a company issues a bond, so of course they make this entry, their debit cash and their credit bonds payable, because that one is liability. But of course, at the end of the year, they have to accrue the interest. So they have to make an entry for the interest expense as well. So after utilizing the money for 1 year, of course, the company has to recognize what they call recognition of expenses. So they have to recognize the interest expense in their books. Yes or no, Junaid?
Yes, sir.
It's like an adjusting entry, remember?
Yes, sir. Yes, sir. Got it.
The kind of entry that we make, like for, let's say, for example, depreciation.
Yes, sir.
Or unearned revenues, okay?
Yes,
so you have to recognize and make an adjusting entry for the interest expense, okay? These entries do not affect your cash because you are not paying cash to the bondholder. The only thing you're doing is actually you are recognizing the interest expense in your books so that your books shows your actual financial position. Okay, suppose if you do not recognize it, so what will happen? It will overstate your income. So for example, you utilize the fund for 1 year, but you did not make an entry for the interest expense for 1 year. So what will happen? You understated your expenses. As a result, your income is overstated. So in order for you to recognize those expenses, what it really means that recognition, or from recognition, I mean making an entry in your books. It helps you to maintain the books according to the financial position of your company. So it tells you actually the true picture of your company. Okay, so all of your expenses.
Sir,
yes, Humayun?
Sir, this entry that you mentioned, Engro is going to do this too?
And oh, yes, of course.
Okay.
Okay, so for example, let's say the coupon rate in this, so the face value of the bond in our example, the face value is 100,000. Okay, and the coupon rate is 10%. Okay, so 10% of 100,000 is how much? $10,000.
Yes.
Okay, so whenever a company recognizes an interest expense, okay, how they do it? As I said, it does not affect your cash position because you're not paying cash. You're only making an adjusting entry. So what do? Interest expense, because it's an expense, so it will be debited by $10,000, and the interest is payable, and it's $10,000. So you created a liability, so that's why it's credit entry, but at the same time you did not pay it. It's only an expense that you will pay next day or maybe after 1 year. We don't know how frequently do they pay to their investors. Okay, so whenever they pay to their investors, of course the interest payable will be reversed, and I'll show you in my next slide. So whenever the entry of interest, so let's say if the company makes, and if the company pays its interest. Okay, so in my previous slide, as you can see, I made an adjusting entry where the interest was payable. So interest expense debit, interest payable credit, $10,000. But whenever the company pays this interest, there is a cash outflow involved. Okay, so the money is going out of their pocket. They are paying that money to the investor. So what happens? The interest payable, if you remember from the previous slide, it was a credit entry. So what we do, since we pay that liability, so we reverse this entry. Okay, and the debit, of course, since we paid cash, so our cash is reduced. So that's why cash is credit. Any question, Humayun or Junaid?
No, sir.
It's super simple, right?
Yes.
Junaid?
Yes, sir.
Okay, so let me go back to the slide and have a look at the slide. So if there is any confusion in the entry, please ask me. I'll give you 20 seconds.
So this one is fine. Kindly turn it on the next slide.
Okay. And this one is the next slide. So the previous one was once you recognize interest. This one, once you pay it.
Paid the
Yes,
liability.
that's why it's here, paid. And that's why it is affecting your cash.
Interest payable, debit and cash. Yeah. When you will pay the interest, of course, the cash will go out of the
Yes,
box. So
out
that
of
will
your
be
pocket,
fair.
right?
Yeah.
Perfect. Okay. Now, let's go to our previous discussion. That why some bonds are, let's say, sold at discount. Some of them are sold at premium, and some of them are sold at even face value. Okay. So let's go back to that discussion. Contractual interest. So every bond, if you remember, I showed you the picture of a bond. Do you remember that, Junaid, from my first lecture?
Yes, sir.
It had what they call stated interest rate. So interest rate was actually written at one corner of that piece of paper.
Yes, sir. Yes, sir.
Okay. So that is stated rate. This is, you can also call it coupon rate. Okay.
Okay, sir.
Now that coupon rate is the contractual obligation of a company. So no matter what, even if your company is making losses, okay, this one is your contractual obligation. You have to pay that. On the other hand, if you look at, let's say, common stock. So common stock dividends, it's not your contractual obligation. You do not have to pay it. If you make money and the board of directors decide that, okay, we will pay our investors, let's say, some dividends, that's fine. It's their option. But in case of bonds, coupon rate or the stated interest rate is actually the contractual obligation of that company. So they have to pay it. Okay, so let's say if the coupon rate is, as I said, 10%, and the face value of the bond is 1,000. Okay, so how much interest is contractual, let's say, if it is payable yearly? How much the company needs to pay each year to the bondholder? It's 10% multiplied by the face value, which is $100.
$100, yeah.
Yes. So the company will pay $100 to its bondholders at the end of each year. And in case of both coupon and zero coupon, at the end of the maturity, the company also needs to pay the face value of the bond to the bondholder. Okay. So let's say if it's a 5 years bond, the company needs to pay face value of the bond to the bondholder at the end of 5 years. But let's say if it's a long-term bond, like 20 years bond, okay? So the company needs to pay face value to the bondholders at the end of 20th year, okay?
Yes, sir.
Now there is another concept, it's called market interest rate. In literature, we also call it the required rate of return, okay? And now what is the difference? This one, the first one is actually coupon. So whatever is stated, whatever you can see on that piece of paper, that one is your contractual obligation. Like for example, this 10%. Okay. But let's say there are two companies. For example, let's say Engro versus let's say Ahmad and Sons, some unknown company. Ahmad and Sons and Lord, let's say Ahmad and Company, okay? And both of them have, let's say, if they're selling bonds, same thing, face value is 100, coupon rate is 10%. What will be the required rate of return, let's say, for Engro and Ahmad? So for example, let's say I'm assuming that for Engro Chemicals, I need at least 8% return. For Ahmad, what do you think? What will make you happy, Junaid?
So rate of return?
A rate of return. So let's say if your required rate of return for Engro Chemicals is 8%, and let me tell you explicitly here. So this one is less risky, and this one is more risky because this one is a very unknown company. I did not know even the name of this company, right? So let's say if as an investor, if you're happy with only 10%, 8% return, okay?
Yes, sir.
What do you think for Ahmad and Company? Should it be more than 8 or less than 8?
So it should be more than 8.
It should be more than 8, perfect. Because the risk is more, you need more return, okay? So if the risk is more, you need a higher return to compensate for that risk.
Yeah, 16, 15%.
Maybe 15, maybe 12, right? It really depends, okay? So the market interest rate, it's a bond specific rate. It's a bond specific rate. For some bonds, it may be low. For some bonds, it may be high. We don't know. It really depends on the riskiness of the company. So do you see the difference now? So the interest rate, which is stated on that piece of paper, the stated interest rate, the contractual obligation, it is different than the market interest rate. And why is it different? Because some companies which are less risky, the investor may need a lower rate of return or a lower required rate of return. But let's say if a company is more risky, they will need a higher rate of return. Like for example, 20% compared to 8%, okay? So whenever the contractual interest rate, like this 10%, is exactly the same as the market interest rate or the required rate of return, the bond is sold at face value, okay? So for example, the bond is paying you as an investor 10%, but you as an investor also need only 10% from that company. So the bond is paying you 10% and you're also happy with 10%. So the bond will be sold at face value, right? These market interest rates actually change daily, okay? So these bonds are actually traded on exchanges. And let's say if you are interested, let's say if you're sitting in the US.
Change daily?
Say it again, Humayun.
Why is it that they change daily the market interest rate?
Just like the stock market, my friend. Okay.
But
so
sir, isn't this something that's also controlled by banks?
It's actually most, it has something to do with the central bank. Okay. So let's say if you need that discussion, for example, let's say if you're applying for a car loan, okay? Normally the banks benchmark it against what they call in Pakistan KIBOR, and let's say plus 5%. Okay? It's a benchmark. And where is this benchmark coming from? It's actually Karachi Interbank Offer Rate. So on a specific day, all banks, it's like a weighted average rate. So the average bank rate that the banks are willing to offer their money for is, let's say, for example, let's say on a particular day, it's 8%. Okay, so let's say if you are applying for a car loan, in this situation, your interest rate for that loan would be 13%. So it's SHIBOR plus 5%. And why the interest rate changes daily? The reason is it really depends on the supply and demand. Okay, number one. Number two, the risk of a particular company also changes on daily basis. Third one, central bank, like for example, State Bank. They may also change rates. They call it policy rate. Okay, so whenever they change rate, SHIBOR adjusts accordingly. And whenever SHIBOR is adjusted, of course, all your consumer loans or even corporate loans, they are also adjusted because they are linked. They are also called floating rates. So they are not fixed. Okay, so these are floating rates. Okay.
Okay, sir.
Yes, sir, I get it.
Okay, perfect. So let me go to the next slide and tell you why some bonds are sold at discount. So for example, let's say if a bond pays 10% and the required is also 10, so it is sold at face value. Face value. Okay. But let's say the bond pays 10%, but the company is a little bit risky. You need at least 15% return on that company. Junaid, tell me, would you like to pay face value for that bond or would you like to buy at discount?
Sir, at discount.
At discount. Good.
Yes, sir.
Reason is the company is paying only 10%, but the company is
Yes, sir.
more risky. You need at least 15%.
Yes, sir.
Okay, so it will be
So
sold
when
at
I'm
discount.
buying it, yeah, okay, sir.
Yes, Humayun, go ahead.
Sir, I didn't say anything.
Okay, okay, good. And did you understand my point for discount?
Yes, sir. Yes, I did.
Perfect. So let me repeat. If the stated interest rate of a corporate bond is 10%, and you as an investor, as a bondholder, you need at least 15% return. So of course, you will buy that bond at a discount. And the quantum of the discount is actually a compensation to cover for that risk. I'm sorry, I'm using some heavy language, but do you understand it, what I mean?
Yes, sir, totally.
Perfect. Okay. So since the risk is high here, the risk is high. So risk is high here. Okay. So the quantum of discount depends on, of course, the quantum of discount is meant to compensate for that high risk. Okay. Now, let's say if the stated interest rate is again 10%, but the company is rock solid and you think that you will be happy even with 7% because the company is solid and you're happy with 7%, your required rate of return is 7%. So will you pay a premium for this bond or will you pay a discount for this bond? Junaid.
Sir, kindly ask it again. I haven't
Okay.
heard this.
Okay. So a company, the stated rate, which is
Yes, sir.
appearing on the piece of paper, is
Yes, sir.
10%.
Yes,
So at
sir.
the end of each year, they pay you 10%. Okay.
Yes, sir.
But the company is rock solid. It's
Yes,
not
sir.
that risky. It has low risk. And even
Yes,
you
sir.
are happy with 7% return. So
Yes,
your
sir.
required rate of return for this particular company is 7%.
Yes, sir.
Okay. So will you pay premium for this bond or will you pay a discount for this bond?
Sir, if I'm taking it for less than the face value.
Yes.
So
No,
then it's discount.
sorry. No.
Yeah.
My apology.
Yeah.
So the face value of a bond is, let's say, 1,000. Okay.
Yes, sir.
They pay you 10% coupon at the end of each year. So which means that you are getting $100.
Okay, sir.
Okay. Now the required rate of return is 7%. So in crude words, right? They're paying you 100, but even you're happy with 70.
Yes.
Because the
So then
company
it's
has low
premium.
risk, it's like Microsoft. So will you pay premium for it or will you pay a discount for it?
Then I'll pay premium for it, sir. They are
You'll pay
giving me
premium
high.
for it because they are paying more than your expectation already.
Yeah, more than my expectations. Yes, sir.
They are paying more than your expectations, right? So you'll
Yes.
pay premium for it. Okay. So
Yes, sir.
this page actually summarizes the whole discussion for you here. So as I said, there is no rocket science to it. Everything is so logical. So let's say if the contractual obligation of a bond is 10% and your market interest rate. So from the market interest rate, I mean a required rate of return. Okay, it's 10%. So that one will be sold at face value. But let's say if the contractual rate is 10% and the required rate is 8%, right? So you'll pay premium. So you're happy with 8. And actually it is paying you 10. So it's more attractive. So it's paying more than your expectation. So you'll pay premium. This bond actually, let's say, exceeds your expectation. Exceeds expectation. Expectation. Right? So if I translate all these numbers for you in words, this bond exceeds expectation for you. This one is as per expectation.
Yes, sir.
As per expectation. Okay, so this is exactly what you're expecting, right? So you pay face value.
And this is less than our expectations.
Yes, below expectation.
Yes, sir.
Why is it below? Because 12% is more than 10%. So it's below expectation. I was expecting more and the bond is paying me less. Okay, so that bond will be sold at discount. Okay, so let's say if in the exam paper, okay, if I ask you a question that, okay, contractual interest rate is, let's say 15% and your required rate is 12%, you should be able to tell me right away whether you will pay premium for it or whether you will pay discount for it. Okay?
Okay, sir.
Now, how do we account for those bonds which are sold at discount? So as I said, three scenarios. One, discount.
Yes, sir.
Okay. One is face value. Okay. And the other one is premium. So the bond will be either sold at discount, it will be either or sold at face or premium. So how do we do accounting for those bonds which are sold at discount? So a company, let's say, sells $100,000, 5 years. So this is maturity now. Okay, so this bond is maturing within 5 years. 10% bond for $98,000. So as you can see, this one is already telling you that the bond was sold for 98. It was sold at less than the face value, means at a discount. Okay. Interest is payable annually on January 1st. So how do we do accounting for it? Of course, if I sold a bond of 100,000 face value for 98, it means that as a company, I receive only $98,000 cash. Is it clear, Junaid?
Yes, sir. Yes, sir. Got it.
Perfect. Okay. My bond payable is 100,000. Now, where is this difference? Where does this difference go to? Okay. So this one is discount on bond payable. Okay. This one is actually a contra account entry. Just like for depreciation, there is an entry, it's called accumulated depreciation. So whatever depreciation is accumulated over the time, that's like a contra entry, right? And as you can see, you get $98,000 cash. There is a discount of minus $2,000, and you created a liability of $100,000. The easiest way to record this transaction is, of course, record cash first. So cash,
Okay.
98K, okay? And you created a liability, so bond payable is 100,000 because it's a face value of 100,000. And at the end of 5 years, no matter what, you have to pay $100,000 because this one, the face value is 100,000. Okay, so your liability actually is 100,000. Now, of course, these entries have to balance out. You have to balance out those entries. Okay, so if $100,000 is on credit side, on debit side, I also have to balance it for 100,000. So if I have already accounted for cash, which is 98,000, where does $2,000 go? It's a discount. Clear?
Yes, sir.
Humayun?
Yes, sir. Clear.
Perfect. Okay. Now, the discount, you have to actually amortize it. So for depreciation, what do? This is like allocation of cost. Okay. And cost or useful life of an asset. Okay, so if it's a machinery, okay, and the useful life is 10 years, you allocate the cost and it's called depreciation. Okay. And let's say if it's for example, okay, so let's say if it's discount, just like let's say for example loan, we also use a word amortization, right? Similarly, the discount can also be amortized or a period of bond. Okay, so if it's a 5 years bond, you amortize the discount over a period of 5 years. And how do you do those entries? Of course, first of all, you have to calculate the cost of borrowing first. So in order to amortize the discount, the first thing you need to do is calculate the cost of borrowing. So what is the cost of borrowing? So again, face value is 100,000, okay? And the stated rate is 10%, okay? So each year you pay $10,000 to the bondholder, okay? So let's say if it's a 5 years bond, you multiply it with 5. So the interest expense alone is $50,000, okay? But you also give a discount. Discount is just like your expense, okay? So your total cost of borrowing is actually $52,000. Humayun, is it clear?
Yes, sir.
Perfect.
Sir,
Junaid, what about you? Is it clear?
can you repeat it in a second?
I will repeat it for you. So the face value of a bond
Yes, sir.
is $100,000.
Yes, sir.
The stated interest rate, which is appearing on the piece of paper, is 10%. This is also called coupon rate,
Yes,
and it's a contractual obligation. So the company pays 10% multiplied by 100,000, which is $10,000 each year to the bondholder. Okay, and since it's a 5 years bond, if I take you back to the slide, if it's a 5 years bond.
yes, sir. Yes, sir.
Okay, it's
Okay.
a 5 years bond.
Mm-hmm.
Okay, let me select my pen. Okay, so 5 years bond. Okay.
Yes. Yes, sir.
So that's why 10,000 is yearly expenses multiplied by 5 years. So the total payment to the bondholders in the form of coupons or the form of interest expense is $50,000. But of course, the $2,000 discount is also going out of your pocket. That is also as an expense, right? So your total cost of borrowing is $52,000.
Okay.
Okay.
Got it. Yes, sir.
Okay. So your annual interest payments is 100,000 multiplied by 10% is 10,000, and for 5 years it is 50,000.
50,000.
Okay.
Yeah.
And you
Then
got
add
a discount.
discount.
Sorry, you gave a discount of $2,000. Your total cost of borrowing is $52,000. Now you have to allocate these $52,000 over a period of 5 years, and that is
Yes.
called the process of amortization. So you're
Okay.
actually allocating the interest expense or the cost of borrowing, to be precise, over a period of bond's maturity. Okay? So let's say if it's for a 10 years bond, you allocate it over a period of 10 years. Okay, what happens, let's say, if I issue a bond at premium? Okay. So discount, I added back $2,000, if you remember. Premium now, I have to subtract it from my cost of borrowing. But now let's see how does I make this entry. Let's say if I issue a bond for premium. So face value of a bond is 100,000. Okay. And let's say if I sold that bond for $202,000. So it means that the additional $2,000 I received was my premium. Okay. And it is also called 102% of the face value. It's exactly the same thing. So I sold a bond whose face value was $100,000, but I received a cash of 102. Yes or no, Junaid?
Yes, sir.
Perfect. But my liability is only 100,000 because my contractual obligation is actually the face value.
Yeah. Okay.
So whatever is written on the piece of paper, okay. So let's say if it is 100,000 K, I have to pay that 100,000 K at the end of maturity.
Yes, sir.
Okay. If it's $1,000, I have to pay $1,000. Okay. Now, of course, I have to balance out the entries. So my debit is 102, and the other entry was 100,000. Now the remaining $2,000 goes as a premium, which is $2,000, and then 100,000 plus 2,000 is again 102,000. Okay. Now, how do you amortize premium? So just like amortizing the discount, we have to amortize. We have to distribute this premium over a period of 5 years. Why 5 years? And why distribution? The reason is my premium of $2,000, I earned this premium on an instrument. Now, this is a technical word. I'm using instrument for bond. So it's a financial instrument, right? It's an investment instrument. You can also call it, okay? Or the $2,000 premium is actually for a bond which was maturing in 5 years. So this premium is not related to 1 year alone. It actually spans over a period of 5 years. So that's why I have to distribute those $2,000 over a period of 5 years. So amortization is actually like allocation, just like depreciation. And from allocation, precisely, it means distribution. Okay. So my cost of borrowing in this situation is actually the interest expense and minus the bond premium. If you remember, I added discount because discount was like an expense, right? But this one is actually coming to my pocket. It means that my interest expense, I have to take this money out, okay? And you do the same calculation, right? So your cost of borrowing in case of premium is $48,000. Okay.
Yes, sir.
Now, this is the final few slides, last 2 slides, in fact. Okay. We will do a very, very quick exercise. Okay. So this is exercise number 1 at the end of the book. Okay. It says non-airline company issued $900,000 of 8% 10-year bonds on January 1st, 2017 at face value. Okay, so if I'm solving this problem, what I'll do, I'll mark those. So this is my face value. This is my coupon rate. Okay, this is my maturity, right? And my other important information is this one is, let's say, sold for face value. Okay, interest is payable annually. Now this one is again important information. At least I will highlight it. Okay, so it says prepare the journal entry to record the following events. The issuance of bond.
Yes, sir.
So how do you do that?
So cash,
Eh?
first cash will be debited.
So cash will be what, sorry?
So cash will be debited to 9 lakh.
Bilkul, 900,000, perfect. And
then it will be bonds
is
payable.
the sorry?
Payable, sir. Bonds payable, yeah.
Bond
cash
payable,
payable.
perfect, perfect, Junaid. Thank you.
Yes.
Bond payable, 900,000.
Yeah, 900.
Okay, so this is the first entry, perfect. Humayun.
So
Yes, sir.
it will be.
So accrual of interest. How
So
do I make
interest
an
expense,
adjusting entry for that?
interest expense will be debited, sir. Interest expense to 9 lakh. And
Okay, Junaid, let Humayun answer this.
then, okay, sir.
Yes, Junaid. Sorry, Humayun.
Sir, we have to write how much interest is accrued on December 31st, or the amount,
Yes.
the amount, or
Yes.
the entry or the amount.
Yes, entry with the amount. So if you see the bond was issued on January 1st, 2017.
Yes.
Okay.
So by the
So
end
of course, you utilize that money for 1 year. Okay.
Yes.
Now you have to recognize. So the second entry is actually for recognition.
So this is going to be 8% of 900,000.
Yes, which is 72,000.
72,000.
Yes. Okay. So this one is what?
Sorry?
So $72,000 is what, Humayun?
It's the interest paid for the first year.
And it has not been paid yet. So you have to recognize it only.
Oh. All right.
So it would be
It's going
interest
to be
expense.
interest payable.
So the interest payable is actually your next entry.
Credit. Yeah.
So
This one
interest
an
payable
interest
is your
expense.
liability. So it is $72,000. But what is the debit entry?
Sir, interest payable and interest expense.
Perfect, Humayun. Thank you for that. Okay. So because you have to recognize it as an expense. Okay. And as I said, what happens if I do not recognize it? So
Of course, then you can't pay it, sir.
Of course, you cannot pay it, but even we can pay it. But what happens? What happens? Sorry for my spell. What happens if we do not recognize interest expense? What happens? Because by definition, the financial statements should show the true financial position of your company. Okay, so if I'm not recognizing this expense, what will happen? I'm understating expenses. True or false, Humayun?
Sir, So the question is, what happens?
What happens if I do not recognize interest expense? And from recognition means that I do not make this entry. Let's say if I do not make this entry in my books, what happens?
Sir, you're understating.
My expenses, because
Yes.
I have incurred an expense. And how did I incur? I utilized somebody else money for 1 year, for which I need to pay them for 1 year as an interest expense. So I have to recognize it. It means I have to make an accounting entry. If I do not do that, I'm understating my expenses. Okay. So for example, let's say if you're, let's say, using, let's say, any data package on your phone, okay, and at the end of the month, let's say, if you do not make a mental entry that, okay, I utilize, let's say, 1,000 rupees or 1,500 rupees, right? And let's say after 1 month or 2 months, you are actually understating your expenses. So whenever you make an expense, although you are not paying it right now, but you still have to keep it in your books. You still have to make an accounting entry for that. Okay. So interest expense, since it's an expense, okay, it's a debit entry, $72,000, and interest payable is $72,000. Okay.
Yes, yes, sir.
Junaid, coming back to you, what happens, let's say, if I pay the interest which was accrued on December 31st?
Yes. So now that you have recognized it, you will put the interest payable as credit, as debit, It will come as
Perfect.
debit.
So we will reverse the entry. Okay. So the
Yes, sir.
payable is paid. So we will reverse it, $72,000.
Yes, sir. And the
And
cash will be credited. Cash will be credited as.
perfect, Junaid. Perfect. Thank you very much.
Yes, sir.
Okay.
Yes, sir.
Mayu, any complication? Do you see any complication in this entry?
No, sir, not at all.
Very, very plain, simple, right?
Yes, sir.
Okay. Before we conclude this meeting, I'll give you an opportunity to ask me any question if you have any.
So everything is clear. I don't need to ask anything right now. Maybe later when I'll go through the lecture again, maybe I'll ask something. But
Perfect.
as of
Okay.
now, I'm clear.
Perfect. So today's lecture was very easy. What we did, we learned about why some bonds are issued at premium, why are some issued at, let's say, discount, and why
yeah.
are some bonds issued at face value, right? So we learned about the logic behind it, okay?
Yes,
We
sir.
compared the stated interest rate with the market interest rate, and then we decided whether we should pay premium for it or whether we should pay a discount for it.
Yes, sir.
Then what we did, for each situation, for example, premium, face value, and discount, right?
Yes, sir.
We made some accounting entries.
Yes,
And
sir.
the most important takeaway from those slides is actually discount as well as the premium. You have to amortize it over the life of that bond. Okay, because the premium is actually for the whole bond. So let's say if it's a 5 years bond, the premium, it's a benefit. So the benefit that you are deriving from that bond should spread out at the life of the bond. You should not record it, let's say, in 1 year, or let's say in the first 2 years. You have to record it in spread it out, or in other words, you allocate it to life of the bond.
Yes, sir.
Super simple. Yes, go ahead, Junaid.
Sir, are there discount and premium exercises as well in the book?
There are some exercises, okay,
Because
self-correction
we didn't
questions.
have them here. Yeah.
Self-correction questions, okay. So what I'll recommend, try to attempt those self-correction questions, and at least give it, let's say, 2 or 3 tries, okay. Accounting, in my opinion, it's not about mathematics. Some students think that, okay, it's not mathematics. It's not mathematics, actually. It's only recording of the numbers. So first of all, you have to analyze an entry, okay, mentally.
Yes.
And then you have to make an accounting entry accordingly in your books. So there's nothing technical about accounting. I mean, as long as you know the basics, in my opinion, you should be okay. The other thing is what I can tell you that as a business graduate, as I told you, we are not training you as an accountant.
Yes, sir.
The purpose of this course is actually that you understand the basics of accounting so that you're able to utilize those information in your decision making. Because business graduates normally, wherever you go, let's say, even if you go to a banking industry, or let's say any other company, or let's say even if you run your own business, at the end of the day, you'll be making decisions on daily basis. Okay, so this course will help you actually understand accounting data and how do you use that accounting data for your what they call managerial decisions.
Yes, sir.
Okay, there's nothing technical to it. You have my email, you have my WhatsApp number. So if you have any questions, please do not hesitate to ask me those questions.
Okay, sir.
Okay.
Sir, next class is going to be on next Friday.
Next will be actually on Monday. So you already have the schedule. We will follow that schedule.
Okay, sir.
Okay.
So, sir, one interactive session a week or 3 are we? What are we doing?
If you like what we can do, actually, we can make it all interactive.
Okay.
Because what my
Sir, I
fear
like
is,
that.
what my fear is, Junaid,
Yes, sir.
sometimes,
Yes, sir.
I'm also talking about myself. Sometimes we lack discipline, right?
Yes, sir.
So, for example, let's say I made you sit actually in front of your computer and I made you actually go through all the material. Even if you don't like it, like Humayun was sleeping, right? I had to call him.
Yes.
I had to wake him up. Okay?
Yes, sir.
So my fear is, let's say if I do recording, sometimes you do not
Yes, sir.
find time to watch those videos. Sometimes you are too busy. Sometimes,
Yes.
I'm not talking about you guys, but sometimes some students are actually not very disciplined. Okay?
Yes.
So let's say if you miss one lecture, the next lecture actually you cannot grasp it. The reason is these lectures are building on previous lectures. So
Yes,
if
sir.
you miss one, you cannot understand the next one.
The next lecture. Yes, sir.
So please tell me whether we should go for, let's say, 2 recorded and 1 interactive, or all, let's say, interactive.
All interactive for me. Sir, today, sorry, I forgot to turn on the alarm, but like I had 3 classes in the morning. So they were all at different times. So somehow my eyes closed. Otherwise, I was up an hour ago.
No, please don't be sorry. At the end of the day, I mean, we made it work, so that's perfectly fine. Okay, so
Sir, I'm
Junaid,
up for all interactive classes.
so yeah, we discussed that, I think, in the past as well. So you are all for interactive. What do you think, Junaid?
Sir, I think 2 interactive sessions would be enough, sir.
Like instead of going for, let's say, 40-50 minutes lecture, what you think is actually 1.5 hour 2 interactive sessions?
Yes, sir.
What do you think, Humayun?
Sir, 2 is also fine.
2 is also fine. Okay, so let's meet according to the schedule.
Okay.
Again, it will be again an interactive session. I like that idea as well. And I think the management also encourages us to do interactive session. Let's say if the class size is less than 50. Okay, I think they have a very valid point, and I totally understand their understanding of the whole situation, and I appreciate that.
Yes, sir.
So we will hold interactive sessions, and then we go from there. Yes.
Okay. Okay, sir.
So thank you very much
Yes.
for your attention, and thank you very much for being with me today.
Thank you so much.
As I said, any questions, send me an email. And if you do not have any question, I think I'll close this session and I'll see you on Monday then.
Okay, sir. Well,
Okay. Okay, sir.
Perfect, Humayun. Thank you, Humayun, and thank you, Junaid. Over and out. Assalamu alaikum.
Walaikum assalam.
so